What's up guys, and welcome back to my YouTube channel. My name is Saman Habibi and I'm a real estate agent here in the Durham region. I've been away for a little bit. A lot has been going on. On the personal side, we sold our personal home. We moved into a new home. Our son Noah is growing up, keeping us very busy. Business has been very good and very busy. We're going to be talking about a lot of different things in today's video. We're going to be going over what's happening with interest rates today and what's the projection for interest rates going forward. We're going to be talking about prices, what has happened to prices since the peak of 2023. We're going to be talking about tax consequences that have come into effect on the short-term rental side and some other things. Also going to touch on duplexes and what's happening with duplexes. And lastly, we're going to talk about, what's in terms of this market. Is this a time where you buy first, sell first if you are going to transact in real estate in 2024? All right, so with that said, let's talk about topic number one, and that is interest rates. As we know, interest rates have been climbing very fast in Canada since 2022. We've had 10 interest rate hikes, which has caused a lot of pain in the market. Every time I read any report about the real estate market here in Ontario or in Canada, they always point to the fact that interest rates are the biggest culprit right now. It's causing cost of living to increase, and as a result, having an impact on a lot of people. When we talk about the mortgage side, there's a lot of articles out there that say payment shocks are coming to most Canadians, and we know this because in Canada, real estate is a levered asset. When you go to buy a property, if you're a first-time home buyer, you can put 5%, 10%, and if you're not a first-time home buyer, you're typically putting down 20%, and the rest is leveraged through a mortgage. And of course, we know that this mortgage is tied to the interest rate. As interest rates rise, these mortgage amounts increase over time. And what's important to note is that in the year 2024 and 2025, we're expecting around 45% of all mortgages to come up for renewal. And in 2026, an additional 25% will be up for renewal. So what does that mean? That means that when we look at people's everyday costs, your mortgage cost or your housing cost is probably one of your biggest cost drivers in your financial scenario on a month-to-month basis. So what's happening is that because these interest rates are rising, we are seeing an increase. We are going to see an increase in mortgage costs to anyone who has a renewal coming up in the year 2024 and 2025. So what I've done here is I've illustrated mortgage amounts. And essentially what I've done is I've calculated what the mortgage amounts would be if your interest rates were at 2.5%. And I'm creating a scenario of what your interest rates will be if you were to renew your mortgage in 2024 at, let's say, 6%. And what does that mean from a increased cost perspective? So if we take a look at the scenarios I've created here, I'll just touch on a few of them. So if you have a mortgage on the smaller side, let's say your mortgage amount is for $400,000. At 2.5% interest rate, your mortgage payments would have been $1,577. If that mortgage rate now renews at 6%, your payments are going to jump up to $2,379, and that would be an increase of $800 a month, on your mortgage. Subsequently, let's say you had a mortgage amount of $600,000. At 2.5%, your mortgage payment is $2,366. And now if you renew that same mortgage at 6%, your new payments will be $3,568. It's an additional payment of $1,202. And let's just look on the higher end. If you have a mortgage amount of $900,000 at 2.5% mortgage rate, your monthly payments are $3,550. That would now jump up to $5,353, an additional $1,803 a month, which is huge. On an annual basis. That would be around $21,000. So I guess the question we have to ask is, how many people have an additional $1,800 a month that they can now fork out and pay towards their mortgage? That's not the only cost that is increasing. We know that when it comes to properties, our property taxes are likely going to increase in the coming years as well. There's some crazy numbers out there in terms of what they can increase for. I've heard as high as 4%, 5%, 6%. And this is just housing. Now you have additional expenses and inflated items such as gas, such as your day-to-day foods at the grocery store that you have to purchase. So this is going to have a big burden on people, and it's going to be troublesome in terms of what this is going to do to the market. So my message here would be that this is a time where you really have to have a grasp of your financials and make sure that your financials are in order. You look at your expenses more than anything. Your income is fixed, but your expenses are keep on increasing. So you really need to have a big handle on that. Perhaps you need to cut back on some subscriptions. You need to cut back on some discretionary spending just to make sure that you have budgeted for this increase that is going to happen if you have a renewal coming up in 2024 and 2025. So, in terms of interest rates, I know we've talked about it a lot, but, in my opinion, in the new year, there are 3 scenarios that can play out with interest rates. Scenario number 1 is that interest rates stay the same. Scenario number 2 is that interest rates come down. And scenario number 3 is that interest rates stay flat and they do not move. These scenarios will have an outcome on what happens with real estate prices. I think most importantly, it has an impact on what's going to happen to your mortgage payments more than anything else, because that is the immediate effect. You're not really concerned as much about prices going up or down if you don't have any plans on selling your property in the near future. But if that is a plan that you have, then of course, you do have a bit of risk there as well. So, best case scenario here would be that interest rates drop and they cut interest rates in the coming year, perhaps Q1 or towards the end of Q2. If they were to do that at 25 basis points, I wouldn't anticipate a crazy, change in the real estate market. 50%, maybe we start to see the market pick up a little bit, prices, if they were to cut prices to go up. And then, alternatively on the, on another scenario would be if they raise interest rates, right? So if they were to, worst case scenario here would be they raise interest rates twice. And of course, we know that would again have another impact on the market. In terms of causing prices to come down. And if interest rates don't move, I would say, prices stay the same, maybe start to drop down a little bit. I would say there's a more likely scenario of home prices dropping if interest rates stay the same, because, you're going to have a lot of people who are facing this financial burden scenario, and they have to decide, do we hold on to our property? Do we go into our savings to kind of pay the difference here? Or do we just put our home up for sale and try and come up with another scenario? Any of these scenarios will essentially, have a bit of an impact on the market, because if more people are to sell their properties on the market, bring it on the market, there's more inventory, there's more active listings, and as a result, supply and demand, and we would see prices come down. So now that we've spoke about interest rates, with interest rates, we always talk about price. I want to give you a sense of what's happened to real estate prices here in the Greater Toronto area, but I'm also going to focus in on the Durham region as well, because that is an area that I operate in. So what I've done here is I've taken a look at the peak of the market for 2023, and that would be approximately around May and June of 2023 is when we saw elevated prices. That's when the Bank of Canada had kind of paused interest rates and was not increasing. So we saw, the market sentiment and the market confidence increase, and as a result, we saw prices, climb. And also because of the seasonality factor in the spring market, we do see an increase in real estate prices. But nonetheless, May 2023 was peak of the market here in the Greater Toronto area and the Durham region for that matter. So what I've done here is I've prepared numbers to show the Greater Toronto area. So this accounts for all of the GTA. In May of 2023, the median price was, I believe this is average, sorry, the average price was $1,040,000, and November month to date, that price, that median price is now $954,000. That is a result of an 8% market correction or 8% reduction in prices. If we look at the Durham region, Pickering in May of 2023, the median price was $999,900. It is now down to $852,000. That's a 15% correction. In Whitby, in May, it was $1,048,000. Now we're down to $917,000. That's a 12% price correction. And in Oshawa, we're seeing a 9% price correction. So this is essentially, the culprit here is two things. It's interest rates, of course, because as interest rates have increased and have remained at this level, it's having a big impact on affordability. So anyone who is able to go out and get a mortgage, they're being impacted by the higher interest rates, because when they go to the bank, there's the interest rate that they have that they will essentially be purchasing the property for, but there's a stress test of, having to qualify at a higher interest rate. So this is having an impact on affordability for a lot of people. A lot of people are having a hard time saying that, we can go out and make a purchase for $1 million, because essentially to make this purchase, you would have to have, an income, a combined household income, over 150, almost maybe even $200,000, which is high, when we kind of consider what the median income is here in the GTA. So, corporate interest rates being one of them, but also because we're seeing a shock in the market with interest rates, a lot of speculators and a lot of people who purchase properties on variable rates for whether it be investment purposes or whether it be pre-construction projects for the purposes of assigning, they're noticing that their rental income that they're generating is not even covering the interest portion of their mortgage payment. So as a result, speculators and people who bought properties at the peak of the market around 21, 22 are noticing that, this isn't really making any economic sense. So as a result, they have flooded the inventory, the current market, with a lot of inventory. So we know that active listings are at an all-time high right now. So what's happening is every month there is high levels of inventory coming to market. And the following month, there's more inventory coming. And the next month, there's more inventory coming. But all the inventory that's come to the market is not selling. So they're grouping and they're adding up. And as a result, active listings are increasing. As number of listings increase and as interest rates stay high, we notice a pressure on prices and we notice prices coming down. And that's exactly what's happened here. And just also on the topic of prices and what we can expect in the coming months, it's important to note that TD did put out guidance for 2024, and this is really important. I'm going to bring your attention to the article that TD has released. And essentially the article starts by saying that in September of 2023, our forecast called for Canadian average home prices to fall around 5% from the third quarter levels through the earlier part of next year. They go on and now to say that we've had to magnify that drop to around 10%. There are two main culprits here. First, the bond yields, and also a larger than anticipated loosening in BC and Ontario's housing market. So here we can see that one of the major banks here in Canada is calling for an approximately 10% correction in prices going forward. So I think this is something that you have to be comfortable with and knowing, accepting that if you are in the market shopping to purchase a home, but also if you're a seller, if you're a buyer in this market, you need to be aware that if you buy today, if you have short-term plans with the transaction that you're about to perform, then this would be troublesome, because if you're speculating for the next year, you have to be aware of this and you have to account for this. And also, if you're a seller and you want to sell your home in this market, then you need to be aware that, whatever you're budgeting for right now, whether it's to cash out or whether it's to kind of plan for your next purchase, you need to be aware that your sales price can be, does have exposure for 5 to 10%. And this is just, someone's guess, an economist's guess. We like to think that they are educated and they have data to kind of support this. And I'm sure they do, but, this market is very volatile. There's a lot of events that cause, news to go up and down and up and down. And guys, I will share the links for these articles with you. So if you want, please check the comment section below, and you'll be able to access the articles that I'm referencing. And again, if you've made it this far, thank you so much. But if you've made it this far, please, if you can like and subscribe to the channel and turn on the notification button, that will be greatly appreciated. Okay, the next thing that I want to talk to you about is some tax consequences and changes that have come into effect in 2023. The first one that I want to talk to you about is called the Underutilized Housing Tax Act. This is what I wanted to say was that the CPAs of Ontario are calling for this whole tax to be axed. So, you still need to be careful and make the declaration just to be safe. But what they're trying to do is that going forward, they're just trying to axe this whole declaration as a whole, so you don't have to make a declaration. But that is not, it hasn't been figured out yet. It's still in the works. So just something to be mindful for the coming months. Okay, the next topic that I want to talk about in terms of taxes is taxes on short-term rentals. So, this new declaration was, this new announcement was put forward by the federal government in a partnership with the CRA. And essentially what they like to do is tax short-term rentals. So essentially the problem here that they're trying to solve is that, in Canada, we obviously have a supply and demand issue. We do not have enough supply to keep up with the demand of housing. And I guess one of the things that the government of Canada is trying to tackle is taking some of the housing stock that is currently being used as short-term rentals and bringing it and using it as long-term homes for people to use. So essentially what they're proposing is that if you are an operator of a short-term rental, on platforms such as Airbnb, VRBO, you are generating rental income. And previous to this announcement, you would generate rental income, you would have some expenses, you would have mortgage expense, you would have your mortgage interest, you would have a home equity line of interest, you would have some maintenance on the property, supplies that you have to purchase for your short-term rentals, equipment, so on. So you would have rental income coming in, you would have some expenses, and then you would have a net income which would be reduced and lower than your total income, and you would pay tax on the net income. And of course people can essentially write off a lot of items to reduce their net income, and as a result reduce their taxes owing. What this new announcement says is that if you're operating a short-term rental in an area across Canada that is restricted, so a municipality has restrictions on the property, you are no longer going to be able to write off those expenses. So you can imagine that this is going to have an impact on a lot of these Airbnb units, because if we take a look at across Canada, a lot of the major areas that investors are likely to purchase Airbnb units are likely going to be in metropolitan areas and highly populated or highly desirable areas such as whether it be Vancouver, Toronto, Montreal, and perhaps even cottage country. But you got to remember that this is tackling areas that have restricted rules on Airbnb. So we know that in Vancouver it's restricted. We know that in Toronto it's restricted as well to a principal residence, and there are X number of days that you can rent it out. We know that in some cottage country there are also restrictions on short-term rentals. So if you own a short-term rental in any of the affected areas in Canada, you can no longer deduct any of the expenses. So you're gonna have a short-term rental income coming in, but you're not going to be able to deduct any expenses, and as a result you're going to have a higher net income, and you're going to have to pay tax on that higher net income. So as a result, you're going to have a tax liability here. Tax exposure is going to increase, and some people are just going to have to decide whether this makes a business sense, if this is within their business plan, if they can eat into their margins, or if not, they're going to have to either sell their property, which means more inventory coming to market in these areas, or just decide if they're going to pay the tax and continue their business. Okay, the next topic I want to talk about are duplexes and what's happening with duplexes here in the Durham region. As you know, and as I've talked about on this channel, the traditional duplex, your bungalow that you purchase and you convert into 2 units, the main floor being 1 unit, and the basement unit, which has a separate entrance, a 2nd unit, has been very popular here in the Durham region. One, because it's a fairly straightforward concept. It's something that you can manage on your own. It's still affordable to a point where you can get in without having to spend a lot of money, and the rental income was still very good. So I've talked a lot about the market in terms of what's happened to these duplexes. At the peak of the market, Feb 2022, these duplexes were selling at an all-time premium. So your finished duplex product in Oshawa, for example, was selling for $1.1, $1.2 million. At the lower interest rates of 1 to 2%, and with the rental income that it was generating, it made sense. But now, because of the elevated interest rate levels, it's not making sense anymore. So as a result, we've seen some investors bring them onto market and sell them. And as a result, coupled with the fact that rents now no longer cover the interest payments, and also the fact that a lot of people are on variable payments, and it's just very hard to maintain. The duplex prices have dropped dramatically. So what once was at a $1.1, $1.2 million purchase price is now anywhere between $800,000 to $840,000. That's now, as of November 2023. Are they still in high demand? Yes, people are still buying them because, as I mentioned, they've kind of stayed at this level all of 2023 and they haven't really dropped further. And the market sentiment is that, we are at the peak of the interest rate environment, maybe a little bit more, but it is pretty much at the peak at the moment. And people have seen these duplexes remain at this price for a pretty long period of time. It's been 6 to 8 months now, and they haven't really fluctuated too much. So as a result, the demand for it is still pretty high to purchase these duplexes. The rental income demand is still pretty good as well. Recently, in the past month, I've had the opportunity to lease out 3 units for clients of mine, and all of the units, as soon as I put them up, we're getting a lot of interest on these properties. Of course, you have to be diligent with who you're providing these units to. So as a result, it can take a bit longer if you're trying to be selective with the group of people that you're trying to bring into your unit. But nonetheless, the demand is still there. And from a rental income perspective, the rental rates did increase quite a bit. Your upper units were renting for $2,500 a month, and your lower unit was renting for around $2,000 a month, plus utilities and hydro. Those amounts have now shifted and come down. So your upper unit is around $2,300 a month, and your lower unit is around $1,800 to $1,900 a month. Okay, so in summary, when it comes to duplexes, we've seen an approximate correction of 24% in purchase price for these duplexes. We're comparing peak of the market Feb 2022 to essentially now. And in terms of rental data, I'm seeing a correction of approximately 6 to 8% in rental income. And again, I'll put these numbers up on the screen so you can take a look at it for yourself. Okay, and the last thing that I want to talk to you about is how to navigate this market. So if you are a buyer or seller in this market, and more so let's talk about sellers, because that's where I think the question comes. What do you do in this market? Do you buy first or do you sell first? In my opinion, in this market, you have to always sell first, and that's simply because there is a lot of inventory and active listings in the market. And essentially what happens is that a lot of inventory gives the buyers all the leverage. So if you as a seller do not like their terms or their price, for that matter, price is the main thing that people talk about. If you don't like their price, they're simply just going to move on to the next property. And as a result, buyers have all the leverage. So because active listings are at an all-time high, and in fact the highest they've ever been since 2013, this is not a good sign for sellers. So if you are a person that is thinking of selling their property and buying a property in the near future, you would want to sell your property first just to make sure the transaction has completed, you have some assurance over the funds coming into your account, and now you can kind of plan and budget for what you're going to do with your next purchase. This would be the wrong market to purchase first and then sell your property, simply because there's a lot of uncertainties over the sale. This is a market where you have to bear no expenses when it comes to selling your property. You essentially have to be the best product that's out there. That means that you have to go as far as perhaps painting your property, perhaps doing some professional cleaning, staging your property, and you perhaps have to sit on the market for a longer period of time as well. Right now, the average days on market is 10 to 15 days. Some properties are even sitting for 30 days. And if it is sitting for that long, it's a price issue and you need to reduce your price. So as a result, if you are a person in this market that's looking to do a transaction in 2024, you need to perhaps consider selling your property first before making any other decision. With that said, guys, thank you very much for watching my video. I hope you enjoyed and got some value from this video. If you want to book a one-on-one call with me, again, my QR code is here. You can take out your phone, scan the QR code, and book a one-on-one call with me, and we can talk about your personal scenario. And if you have any questions, feel free to drop them in the comment section below, and I will do my best to answer any questions that you have.